Imagine a country that in 1945 lay in absolute ruins. Its cities burned, its economy shattered. Two atomic bombs had just ended the deadliest war in human history, and this country was on the losing side. Now fast forward just 40 years. That same country had become the second largest economy on the planet. Its companies were buying American landmarks, its banks were the biggest in the world, and its GDP per capita had surpassed that of the United States. That country? Japan. This is not just a story of economic recovery. This is one of the greatest financial transformations in the history of human civilization. Today, we're going to break it down chapter by chapter, decade by decade, with real numbers, real data, and real consequences. Stay till the end, because the final chapter will surprise you. To understand the miracle, you first need to understand the starting point. In August 1945, Japan surrendered to the Allied forces. The destruction was almost incomprehensible. Here are the real numbers. Over 2.7 million Japanese soldiers had died in the war. 500,000 to 800,000 civilians were killed in Allied bombing raids. 66 major cities had been firebombed, including Tokyo, Osaka, and Nagoya. Hiroshima and Nagasaki had been obliterated by atomic bombs on August 6 and 9, 1945. Japan's industrial output had collapsed by 90% compared to pre-war levels. GDP per capita in 1946 was estimated at just $250, placing Japan among the world's poorest nations. The country was under U.S. occupation. General Douglas MacArthur controlled its administration. There were food rationing, hyperinflation, and widespread unemployment. Japan had absolutely nothing. But here's what Japan did have, something that no bomb could destroy. It had people. 70 million disciplined, educated, determined people. It had a culture of collective sacrifice and hard work, what the Japanese call gaman, enduring the seemingly unbearable with patience and dignity. And, crucially, it had a new government that was about to make some of the smartest economic decisions in history. Under U.S. occupation, Japan got an unexpected gift, an economic blueprint designed in Washington. In 1948, U.S. economist Joseph Dodge was sent to Japan to stabilize its economy. His plan, known as the Dodge Line, was aggressive. Balanced Japan's national budget to stop government overspending, fixed the yen at 360 yen per U.S. dollar, creating currency stability, cut off direct U.S. subsidies to force Japanese firms to compete on world markets, broke up the zaibatsu, the massive monopolistic family-run industrial conglomerates that had dominated Japan since the Meiji era. Now, this last point is critical. The U.S. wanted to democratize Japan's economy by breaking up concentrated corporate power, but ironically, what replaced the zaibatsu became even more powerful, the keiretsu. Keiretsu were networks of interconnected businesses, banks, and trading companies tied together by cross-shareholdings. Think Toyota surrounded by its ecosystem of parts suppliers, its house bank, its trading company, all interlocked. This model created extraordinary efficiency and loyalty throughout the supply chain. Meanwhile, the Korean War, 1950 to 1953, gave Japan's recovery an unexpected rocket boost. The U.S. military needed supplies, vehicles, ammunition, electronics, food, and Japan was right next door. Between 1950 and 1953, Japan earned approximately $2.4 billion in U.S. military procurement orders, equivalent to over $28 billion today. This single windfall reignited Japan's industrial engine. By 1952, when the U.S. occupation officially ended, Japan's GDP had recovered to pre-war levels. The comeback had begun. Now we enter the most extraordinary phase in Japan's story. Economists call it the Japanese economic miracle, and the numbers are mind-blowing. Between 1955 and 1973, Japan's economy grew at an average annual rate of 9.7%. Let me put that in perspective. The United States, during its best post-war decade, grew at around 4% per year. Japan was growing at more than twice the American rate for nearly 2 decades. Here's the data in concrete terms, and these numbers will blow your mind. In 1955, Japan's total GDP stood at just $24 billion. 5 years later, by 1960, that had nearly doubled to $44 billion. Then, by 1965, it doubled again, reaching $91 billion. By 1970, Japan had crossed $212 billion, and by 1973, $432 billion. From $24 billion to $432 billion in just 18 years. That is not growth. That is a financial supernova. What drove this? 3 powerful engines. Engine 1, MITI, Ministry of International Trade and Industry. The Japanese government didn't just stand back and let markets do their thing. MITI actively guided which industries Japan should develop. In the 1950s, it was steel and shipbuilding. In the 1960s, automotives and electronics. In the 1970s, semiconductors and precision machinery. MITI provided cheap credit through state-directed banks, protected infant industries from foreign competition, and set ambitious export targets. This was state-guided capitalism, and it worked brilliantly. By 1970, Japan was producing 9 million tons of steel annually, becoming the world's 3rd largest steel producer. Engine 2, Education and Labor. Japan invested heavily in education. Literacy rates exceeded 99% by the 1960s. University enrollment tripled between 1950 and 1970. The concept of lifetime employment, where companies hired workers straight out of university and kept them for life, created fierce loyalty and a culture of continuous improvement called kaizen. Workers didn't just do their jobs, they suggested improvements, they protected quality, they identified waste. Toyota's famous Toyota production system, the foundation of modern lean manufacturing, emerged directly from this culture. Engine 3, Exports. Japan made things the world wanted to buy and made them better and cheaper than anyone else. In 1960, Japan exported $4 billion in goods. By 1973, that figure had exploded to $36 billion. Key exports included steel and ships, motorcycles, Honda dominated globally, consumer electronics, Sony, Panasonic, Sharp, and automobiles, Toyota, Nissan, and Honda. In 1967, Japan overtook West Germany to become the 2nd largest economy in the world, a position it would hold for the next 42 years. In October 1973, everything changed, not just for Japan, but for the entire world. The OPEC oil embargo sent crude oil prices skyrocketing from $3 a barrel to $12 a barrel almost overnight. For Japan, which imported nearly 100% of its oil, this was catastrophic. Japan's economy went into negative growth for the first time since the Korean War period. Inflation hit 23% in 1974. Industrial output fell sharply. But Japan's response to this crisis revealed something extraordinary about its character. Instead of collapsing, Japan adapted with remarkable speed. Japanese manufacturers slashed energy consumption. Between 1973 and 1980, Japan reduced energy use per unit of GDP by 35%, one of the fastest energy efficiency improvements ever recorded. Toyota and Honda now had a massive competitive advantage. Their small, fuel-efficient cars were exactly what American and European consumers suddenly needed. In 1975, Toyota Corolla became the best-selling car in the world. U.S. car manufacturers, with their large, gas-guzzling vehicles, were caught completely off guard. By the late 1970s, Japan had not only survived the oil shock, it had emerged stronger and more competitive than before. The second oil shock of 1979 barely slowed Japan down. The country had already restructured. By 1980, Japan's GDP reached $1.1 trillion, representing about 10% of total world output. The 1980s. This is when Japan didn't just become wealthy, it became almost frightening in its dominance. In 1985, the Plaza Accord was signed in New York. The US, UK, France, West Germany, and Japan agreed to deliberately weaken the US dollar relative to the yen and Deutschmark. The goal was to reduce America's massive trade deficit. For Japan, the yen nearly doubled in value against the dollar between 1985 and 1987, from 240 yen per dollar to just 128 yen per dollar.
This made Japanese exports more expensive. To compensate, the Bank of Japan slashed interest rates and flooded the economy with cheap money. And then something extraordinary and dangerous happened. All that cheap money had to go somewhere. It poured into stocks and real estate. The numbers became surreal. The Nikkei 225 stock index rose from 13,000 in 1985 to nearly 39,000 by December 1989, almost tripling in 4 years. Land in Tokyo's Ginza district reached prices of $1.5 million per square meter, making it the most expensive real estate on Earth. The total land value of Japan at the bubble's peak was estimated at $20 trillion, roughly 4 times the land value of the entire United States, despite Japan being 1/25 the size. In 1989, the 7 largest banks in the world were all Japanese. In the same year, Japan's Mitsubishi estate bought Rockefeller Center in New York. Sony bought Columbia Pictures. Japanese investors seemed to be buying the world. Japan's nominal GDP hit $3.1 trillion in 1990, and on a per capita basis, it briefly surpassed the United States. At this moment, many analysts genuinely believed Japan would soon become the world's largest economy. They were wrong. In late 1989 and into 1990, the Bank of Japan, alarmed by runaway asset prices, began aggressively raising interest rates. The bubble popped with devastating force. The Nikkei 225 fell from its peak of 38,915 in December 1989 to 14,309 by August 1992, losing 63% of its value. Real estate prices collapsed by 70 to 80% from their peaks. Japanese banks were left holding trillions of yen in bad loans, loans backed by collateral that was now worth a fraction of what had been borrowed. Between 1991 and 2003, an estimated 100 trillion yen, roughly $1 trillion in non-performing loans, paralyzed the banking system. Major financial institutions collapsed. Yamaichi Securities, Japan's oldest brokerage with $260 billion in assets, went bankrupt in 1997. GDP growth averaged just 0.5% per year throughout the 1990s, compared to over 9% in the miracle years. Japan entered what economists would call the lost decade, which became the lost 2 decades. Deflation, the opposite of inflation, where prices keep falling, gripped Japan for years. And deflation is a particularly nasty trap. When consumers expect prices to fall tomorrow, they delay spending today. Businesses postpone investment. The economy stagnates. The government tried massive stimulus programs. Between 1992 and 2000, Japan spent approximately $1 trillion on public works and infrastructure, bridges, roads, airports. Some of these were in areas that barely needed them. The national debt exploded. From around 60% of GDP in 1990, Japan's government debt ballooned to over 150% of GDP by 2000, the highest among developed nations. And then, in 2008, the global financial crisis hit. Japan, already weakened, saw its exports collapse as global demand evaporated. GDP shrank by 5.5% in 2009, its worst post-war performance. In December 2012, Shinzo Abe returned as Japan's prime minister with an ambitious economic plan that the world would come to call Abenomics. Abenomics was built on 3 arrows. Arrow 1, aggressive monetary policy. The Bank of Japan, under Governor Haruhiko Kurutara, launched the most aggressive money-printing operation in history. Japan's central bank eventually became the largest shareholder in Japan's stock market through ETF purchases. The result? The yen weakened significantly, boosting export competitiveness. The Nikkei rose from around 8,500 in late 2012 to over 24,000 by 2018, almost tripling in 4 years. Arrow 2, fiscal stimulus. Government spending on infrastructure, defense modernization, and social programs. Arrow 3, structural reform, encouraging women to enter the workforce, womenomics, corporate governance reform, deregulation in select sectors, and opening Japan to more foreign investment and labor. The results were mixed but significant. Japan achieved 25 consecutive quarters of economic growth, its longest run since the 1980s. Unemployment fell to just 2.4% by 2019, a 25-year low. Corporate profits reached record highs. Japan's GDP in 2022 stood at approximately $4.23 trillion, making it still the world's 3rd largest economy. But Japan now faces structural challenges that no policy arrow can easily fix. Aging population. Japan has the oldest population in the world. By 2025, 30% of Japanese citizens are over 65. By 2050, that figure could reach 40%. An aging population means fewer workers, lower consumption, and higher social security costs. Declining birth rate. Japan's fertility rate is just 1.2 children per woman, far below the replacement level of 2.1. Japan's population peaked at 128 million in 2008 and has been falling since. National debt. Japan's public debt is now approximately 260% of GDP, the highest in developed nations historically. Yet despite all this, Japan remains a financial powerhouse. Despite 2 lost decades and a shrinking population, Japan's financial position remains remarkable. Fact 1. World's largest creditor nation. Japan holds $3.2 trillion in net foreign assets, making it the world's largest creditor nation for over 30 consecutive years. Japan owns more of the rest of the world than anyone else owns of Japan. Fact 2. Foreign exchange reserves. Japan holds the world's 2nd largest foreign exchange reserves, approximately $1.2 trillion, surpassed only by China. Fact 3. Stock market. The Tokyo Stock Exchange, TSE, is the world's 3rd largest stock exchange by market capitalization, with listed companies worth over $6 trillion combined. In early 2024, the Nikkei 225 broke 40,000 for the first time ever, surpassing its 1989 bubble-era peak after 34 years. Fact 4. Technology and patents. Japan files more patents per capita than almost any other nation. It leads the world in industrial robotics. Japanese companies like Fanuc and Yaskawa supply nearly half the world's industrial robots. In key materials needed for semiconductors, like fluorinated polyamide, photoresists, and hydrogen fluoride, Japan controls 70 to 90% of global supply. Fact 5. Sovereign wealth and pension. Japan's Government Pension Investment Fund, GPIF, is the largest pension fund in the world, managing over $1.5 trillion in assets. So what can the world learn from Japan's extraordinary journey? Lesson 1. Human capital is the ultimate resource. Japan had no oil, no vast mineral wealth, no large landmass. Everything it built was built by people, through education, discipline, and relentless improvement. Lesson 2. Export-led growth is powerful, but has limits. Japan's miracle was built on selling to the world, but overdependence on exports left it vulnerable to yen revaluations and global downturns. Lesson 3. Asset bubbles are dangerous precisely when they feel like prosperity. In 1989, everything in Japan looked fantastic on the surface. It was the moment of greatest confidence and greatest danger. The crash that followed cost Japan an entire generation of growth. Lesson 4. Demographics are destiny. No amount of monetary policy can fully compensate for a shrinking, aging workforce. Japan's biggest challenge today is not financial, it is biological. The country needs babies, or immigrants, or productivity breakthroughs from robotics and AI, and it's pursuing all three. Lesson 5. Resilience is a competitive advantage. From the ashes of World War II, through oil shocks, financial crashes, a devastating earthquake and tsunami in 2011, a global pandemic, Japan keeps standing. That resilience, cultural, institutional, social, is perhaps its most underrated asset. Japan's story is far from over. A country that went from $250 per capita income in 1946 to briefly having the world's most expensive real estate in 1989. A country that built brands, Toyota, Sony, Nintendo, Honda, Panasonic, that are recognized in every corner of the earth. A country that is now quietly positioning itself at the center of the coming age of robotics, advanced manufacturing, and AI hardware. The lost decades were real. The challenges ahead are real, but so is the foundation. $3.2 trillion in net foreign assets, the third largest economy on Earth, and a culture that has never, not once, given up. Japan didn't just become a financial giant through luck. It did it through strategy, sacrifice, education, and relentless adaptation. And that, perhaps, is the most important lesson of all. If you found this video valuable, please like, share, and subscribe. Leave a comment below. What aspect of Japan's economic story surprised you the most? And next week, we're going deep into South Korea's economic miracle, another jaw-dropping story of transformation that you won't want to miss. See you then.